Our 3 cycles correctly predicted the last 5 trading days in the S&P. What do they say next? And what's the bigger picture that's going to be happening for the S&P over the next months? We're looking at a 208 trading hour cycle, a 440 trading hour cycle, and a 1,068 trading hour cycle. And when you look at them, you find that when they agree, oftentimes the coherence of these cycles working together tends to create the actual market, tends to create an accurate forecast. When they disagree, you have less confidence in what will happen. But we did say that this week, starting on the 26th, all 3 of them went down. And today, the 26th, the market started down. And we're expecting a few more days where the market will decline. And exactly where, we don't know, but we're assuming a likely target is they would have a retest of the 5,000 area, which was where the last low came in, which was at 49.60 or 49.80, the last few lows. We want to do something interesting today. I want to introduce my partner, my wife, and also she's a financial journalist, used to be in New York City, and she's very familiar with the markets. And what's really cool is she also has a pretty good handle on what people feel about the markets and what people want to know. And so we're going to sit and talk a little bit today.
Hi.
And she's going to ask me questions, and we'll just have a conversation and see if you guys like it. Hi, Laure. This is kind of interesting and fun.
It's a new role for both of us.
Yeah, exactly. You should see some of these conversations. They're definitely worthy of the movies.
Okay, so let's see here. Do the smaller cycles change the larger cycles?
That's cool. No. The big is big and the small is small. If there's a big wave moving and there are small waves in the same arena, the small waves will be overpowered by the big ones. But most of the time, the big waves just keep going in one direction. They don't change direction as often. So only when they start to shift gears is it going to interfere with what otherwise could be the short-term cycles predicting a pretty accurate future for even months. And what we've seen in this most recent, with this 3 cycles that we're looking at, is they've been pretty accurately forecasting the model for the since November of last year. The ups and the downs and even some of the very subtle highs and lows were mapping into what actually did happen. And so it's called wave mechanics, and wave mechanics works if you have the right waves. And the trick is finding those waves, which is what we do. But the big stuff's gonna overpower these waves eventually.
So the wave mechanics. Explain that a little more?
Well, wave mechanics is simply saying that there's more than one cycle in the market. Some of them are moving up, some of them are moving down. And what you want to know is what's the net result of all of them together. So the ones that are moving up are going to put pressure on the up, and the ones that are moving down are going to put pressure on the down. The way you do it is you add the amounts together. So if one is 6 units up and 3 units up, that's 9. And if one is 5 units down, you subtract 5. And you divide the whole thing by 3. So it's kind of averaging the effect of each of these waves. And when you do that, you get kind of what's called a composite wave. It's done in physics. It's done in radiomechanics. It's normal science, actually, in terms of how to combine complicated systems that have numerous moving parts into a composite. A composite means what's the sum of all of them together. And we hope that if we do it right, that the sum of all of them together are going to look like the market. The market doesn't look smooth. The market doesn't look easy. It jangles, it jingles, it goes up, it goes down sharply, sideways for no. So the whole thing is it's a compound wave. And the wave mechanics is a way of kind of taking it apart, trying to understand what the components are doing, and then putting the components back together to get the composite wave. If you do it accurately, you get a good forecast.
In the past, we've used and shown some visuals that they're kind of boring. They have, instead of the nice bright lines, they're kind of pale lines with pink and pale blue. And you use a program to get, this is the most similar, this is the next most similar, this is the next most similar. And sometimes that program adds the cycles together. Is One, is this the same thing? Two, do you use that program to do it?
Well, that program, I didn't write that program. Our software guys didn't write that program. It's something that I bought a long time ago, and maybe 40 years ago. And basically, it's a pattern recognition program. What it does is it finds chunks of the past and the ones that are similar to the present, it puts them on a list. The ones that are the most similar, second most similar. So then what you can do, it does the thing about combining them. All it does is it adds all these together. It adds this and this and this and this together, and they get a compound. You get something. And that is, the mechanics is the same, but the starting point is you have to have the right patterns. If you don't have the right patterns and you add them together, you're going to get the wrong answer. So the program is helpful, but the skill is still like, how do you find which pieces are really going to repeat into the future, as opposed to the ones that look good the last 6 months, but they're not going to continue to forecast what actually happens in the future. There's a skill and a knowledge required in order to tell the difference. So pattern recognition and those software programs can be cool. For example, recently, it was interesting, looking at the top 10 best matches for the last year, it turned out all 10 of them, which is weird, doesn't happen often, all 10 of them said the market's going to go higher like for a few months, right? That's unusual, you know? And a situation like that is fairly reliable also, because the odds of a market continuing higher may be 55, 60%. You know, the market's been trending higher for 200 years. So the odds of an up market are greater than a down market. But if you have all of the best matches agreeing the market's going to go up, you better be careful going short. And also, interestingly enough, if you get like 70 or 80% of them saying it's going to go down, when only 40 or 45% of them usually would go down, that's also a danger zone where, you know, the coherent agreement is a whole bunch of cycles are saying it may go down. So you can use those pattern recognition programs, but unless you know how to find the right patterns, generally speaking, you know, half of them say it's going to go higher and half of the patterns say it's going to go lower. You don't know which ones to listen to. And so it's not that helpful. But we use it as a backup. Once we already know where to look, and then you want to add them together, then you're going to get a pretty good forecast.
Are we going to have a visual that I'll add to this video, because I do the editing, that will show all three together?
Yeah, I have one.
Did you use that program to do that?
No, I have a different program.
Okay, you have the program.
Yeah,
okay.
We have
our
own thing.
All right, good to know. You mentioned something about longer term?
Yeah, I mean, we want to know where we are in the context of the whole, you know. I mean, the day traders are going to be happy getting out at the end of the day, and they don't really care what's going to happen over the next month. But the intermediate term swing traders and the general investors in the world want to know, what's the market going to do? Is it going to go up or not? It's making all-time highs. Should we be nervous? Or should we jump in because it's going to keep shooting higher? And that knowledge is not easy to come by, and many, many opinions are out there, and you don't know what to do or who to listen to. So the bottom line is, if you can find a reasonably good methodology for forecasting, which we feel we have, then you cut out a lot of the noise, a lot of the confusion. You don't have to listen to all the experts. You just make your forecast, you put the waves together, you create the future path, and most of the time you're going to find that you're right. This market is going to go higher. It's not going to go higher forever. But based upon what we've seen, it's going to go up until like late May. And it's not going to go shooting straight up and not stop. As a matter of fact, we've had the easy part already. You know, the market rallied really strongly all the way from October 27th. And it's had very few hesitation periods. Now I think the rallies will be followed by more boring and choppy and even corrective patterns on the way up. We're probably in the fifth wave of this rally. But this fifth wave may turn into what's called a diagonal triangle, which is a B, C, D, E. So it goes up, but the down moves in the middle can be kind of giant. Not taking out the prior lows, but almost. And that's a very hard market to trade. So I think the fun and the easy stuff may be over. This next rally up into early April may still be fairly dramatic, because the cycles are showing that they're agreeing that the market should rally immediately after this week. But after that, the April decline may be meaningful, and the rally in May may be sharp. But again, it will be hard to catch it unless you know pretty much when that April thing is over. So, and then after May, most of the bigger cycles are saying that the market's going to fall. We found 3 of them: the 18-year cycle, the 28-year cycle, and the 88-year cycle. All have really similar storylines going forward, and they're all real. The 18-year cycle is something that is based upon our work. We've seen that it's a valid cycle. The 28-year cycle has been seen by other people, and it turns out the 28-year cycle is reliable. In a general way, it's been working pretty much 200 years now. And so 1996, which is 28 years ago, is repeating fairly closely. And 2005 into 2006, we're now in 2006, is repeating pretty closely. And 1935 and 1936 are very, very similar. And they've been working for, 2-3 years now. So we can't ignore the fact that these things agree with each other. We can't ignore the fact that they're bullish. And we can't ignore the fact that they all call for a break over the summer. So that's pretty much our forecast. It's not complicated. But you need is reliable information, and you need to know the right places to look. We have mathematical tools that are profound and easy to use, but very, very profound, that let us find the right cycles. And once we find the right cycles, you can make right forecasts. Anybody can do it. It's not really hard. You don't need to be a mathematician to do this stuff.
One of my favorites, because I'm more involved with it, is the matrix channels. And I think we actually did pretty good recently.
Yeah, last week, the matrix channel on the hourly level, the hourly chart, the low of the week came in right on our line, and it turned up, and then you wouldn't get in right there because it's too risky. But after the first wave up, the first hour up, it had a buy signal. And that was before the NVIDIA report came out. So that move, you didn't get it at the low, but you got it 1 hour after the low. And the whole rally all the way up into the 23rd, this thing caught. It was a beautiful trade. And a scary one, because most people had no clue what NVIDIA was going to do. A lot of people were bearish. We didn't even know what NVIDIA was going to do. We just knew that we were supposed to go long, and we know the cycles are up. So we don't know what's going to cause the ups. We don't know what's going to cause the downs. But oftentimes the cycles tell you what's going to happen. And if you believe them, and most of the time they're right, you would have been buying NVIDIA, not selling it.
By the way, with the matrix channel indicator, we tested the indicator for months. And then, of course, the moment we took it live, all kinds of weird things started happening.
But it's not like it didn't work. It's just the electricity would go off in the middle of the night. The charts would disappear in the middle of the night, and we didn't know why.
The matrix channel lines themselves worked fine, but turns out that offering something live stream 24/7 is not a simple thing. And so that's that kind of technical matter is what we're working on, so that people have the information they're supposed to have, that does help them, but they have it at the right time. You kind of did, but I know I've spoken with you, so I think it's good to make this more clear. There's some congestion, so it's not like really straight one way or another in the next couple of months.
Yeah, that's a good point. Like the thing is, let's say the market goes up into late March and it has a nice shoot up for 2-3 weeks and everybody's really happy. It's not likely to keep going right away. As a matter of fact, in April, it might come most of the way back down that it just did in March, but not all the way. So it turns out it's up and then most of the way back down, and it takes a long time to do that. So it's kind of boring and annoying and nothing's going on. Then it shoots up again in May. This type of stair step, but with big steps, big sideways periods in the interim, that's more or less what we're looking for. I think the easy money is not available anymore. I think there'll be different leadership in different sectors taking over, and some of the stocks that are high flyers may not be high flyers. Some of the ones that are lagging behind will start to pick in. But ultimately, the market's going to figure out a way to go higher, and it may go even higher than the 5,400 that we were anticipating. But you'll see it. I mean, if it goes to 5,400 in March, it's probably going to go higher than that in May. Just use your head.
Oh, that.
We don't know exactly where it's going to go, but we do know where the strengths and weaknesses are. We do have very intelligently structured projection points, which can be exceeded if the market is even stronger than we think. But they're reasonable.
I may throw him a softball or two, or a hardball. Who knows what comes up. But also, if you have some questions, put them in the comments, and maybe I can get them in there.
Yeah, if you like what we just did, we'll do it again. This is YouTube. We're free to kind of play around with different ideas. And the whole point here is to give you information about the markets, to educate you on what you can do in the markets, which is our Trade Forecast Mastery course, and also for you to feel comfortable moving into the arena of trading in a way which avoids all the chaos that most traders experience at the beginning, which is they lose money. So to avoid that, you need to have some additional tools, and we try to help people to get on their right footing more quickly, make some money, be able to do it wherever they are, at home, wherever. If they want to travel, they can still make money with a computer.